Hello, welcome. I'm Shubham, a qualified chartered accountant in the UK, and this channel is called Let's Talk Money, where we talk about real money issues in simple language. Today, I want to show you how landlords in the UK can legally pay less income tax on their rental income. So, if you own a rental property or if you are thinking of buying one, this video can save you a lot of money. Let me be clear upfront. This is not about loopholes or anything risky. This is about being understanding the rules and using them properly. Why rental tax matters. Real estate is one of the most common investments in the UK. But what I see all the time is landlords overpay tax simply because they don't understand what they can claim. So today I will cover in this video what a tax write-off actually is, key expenses landlords often miss, and an alternative way of owning the property that can be more tax efficient. What is a tax write-off? A tax write-off is just an expense you are allowed to deduct from your rental income before taxes. Let's understand it with a very simple example. Say you earn £24,000 a year from one rental property. If you are a basic rate taxpayer, that is 20% tax rate, your tax would be £4,800. Now imagine you had £6,000 of allowable expenses. Your taxable income would drop to £18,000. Tax at 20% would be £3,600. So you have saved £1,200 in tax. Key tax write offs landlords should know about. This is not a full list, but these are all the areas where people mostly underclaim their expenses. First one is mortgage interest, a big rule change. Before 2017, landlord could deduct 100% of their mortgage interest. That rule is gone now. Now, you don't deduct mortgage interest from your income. Instead, you get a 20% tax credit on the interest paid. What does this mean in real life? There won't be any impact for the basic rate taxpayers, but it is not same for the higher rate and additional rate taxpayers. This is the main reason why many landlords now look for company ownership. Mileage cost. A quick question. Do you travel to your rental property for inspections, repairs, tenant issues, etc.? If yes, your mileage cost is deductible. HMRC allows you to claim your mileage, but only if it is related to your rental property. You keep a simple mileage log, and most people forget this completely, and it adds up over the year. Replacement of domestic items relief. This one confuses a lot of people. You can claim the cost of replacing movable items like fridge or freezer, washing machine, carpet or rug, bed or sofa, but only if it is a replacement, not the first time you buy it. If something breaks or wears out, replacing it is an allowable expense. Be careful though, if it is a fixture like new shower or structural upgrade, it may be capital expenditure instead. Miscellaneous expenses. Don't ignore the smaller cost. Example, cleaning cost, ground rent, service charge, tenant finding fees, letting agent fees, etc. All of these are usually allowable deductions. The key rule here is simple. If it is wholly and exclusively for the rental property, it's worth checking. One honest warning: not every cost is automatically deductible and rules change. So don't just guess. Always check or speak to your tax advisors before submitting your tax return. Buying property through a company. So far, we have assumed you own a property personally, but many landlords now buy through a company, a limited company. Why? Main reason: companies can deduct mortgage interest in full. That alone can make a big difference for higher rate and additional rate taxpayers. Company versus personal. Let's compare both the situations now. Tax amount if you buy a property through company. Let's say your rental income is £24,000. Your mortgage interest is £12,000. Other cost £5,000. Your taxable profit would be £7,000. Corporation tax at 19% would be £1,330. And your profit will be £5,670. If you withdraw that as a higher rate taxpayer, that is 40% tax rate, your total tax would be around £3,600. That is 1,330 plus 2,268. Now let's find out the tax amount if you buy a property through personal ownership. Your rental income, again, same, let's say £24,000. Other expenses would be £5,000. Your taxable income would be £19,000. Tax at 40% would be 7,600. Then you get a 20% mortgage interest credit. That means 7,600 less 20% on 12,000, that is 2,400. Your final tax would be around £5,200. What does this tell us? In this example, company ownership is more tax efficient, but there are other factors as well, because companies comes with admin cost, accounts, corporation tax returns, setup cost, etc. So it is not for everyone. There is no one answer for all the questions. But if you are a higher rate taxpayer, have a mortgage, plan to grow a property portfolio, then company ownership is something you should seriously think. If you found this video helpful, share it with someone who owns rental property. And subscribe to Let's Talk Money with Shubham for practical, real world tax and money advice. I will see you in my next video. Until then, keep learning and keep watching.